Welcome to The Man from Macro, where we look at some of the big themes in today's global markets. Over the last week, we've had the US Federal Reserve announce no change on interest rates, and a reminder of last year's banking crisis, when New York Community Bancorp's share price plummeted. This is the entity that bailed out Signature Bank during last year's regional banking turmoil. Part of the issue was that after the rescue, the increased size of its balance sheet pushed the bank into a stricter tier for the capital requirement that it is now expected to hold. The issues in the banking sector are not going to go away anytime soon. Short-dated yields are still higher than longer-dated yields, which means it's hard for banks to earn money by borrowing at the short end and lending at the longer end. Regional banks are also struggling to offer competitive levels of interest on their retail deposits, which means that the steady outflow to money market funds has continued. Cash in those funds has recently hit a new high. Additionally, there is still uncertainty across segments of the commercial real estate markets. This means that investors remain reluctant to commit capital to a sector which is still extremely fragmented. But none of this is new. We have known for well over 12 months that these regional banks are sitting on significant unrealized losses. The issues with New York Community Bancorp are not an escalation of that situation. Furthermore, the Fed continues to have a backstop in place via the Bank Term Funding Program. This continues to expand, although most of this expansion was an arbitrage opportunity, borrowing from the fund and then receiving a higher return elsewhere at the Fed. The Fed has tried to stop this by recently raising the borrowing costs. Also, the program is still expected to expire on March the 11th. But despite this, US policymakers remain ready and willing to deploy old and new tools when each macro risk rears its head. Additionally, the banking sector can remain on life support for a very long time. A couple of weeks ago, we noted that the Japanese equity market was readying itself for an assault on the all-time highs. But, in amongst that, the relative performance of the Topix banking sector versus the broad Topix index is still loitering near the 30-year lows. Underperformance from banks doesn't mean the economy will implode, though it might imply that the economy is somewhat dysfunctional. The bottom line is that regional banks are a drag, but they are unlikely to cause an event beyond the scare that has already been provided. The Federal Reserve will continue to use macro-prudential tools to alleviate the worst pain. Therefore, although bond yields have recently fallen, prompting some expectation of a rate cut at last month's FOMC, policymakers will continue to focus on price rather than growth. At the moment, price is still a long way from hitting their 2% target, and as we noted last week, the jobs market remains tight, even if it is not strong. Unemployment is still close to record lows, and it would need a big acceleration of job losses to change that. Whilst we have seen a slew of job-cutting announcements in the press recently, we also need to see the equity market materially pull back in order for corporate leaders to decisively cut jobs across the board. For now, this probably means that the market is still being too optimistic on the number of rate cuts that we'll get in 2024, and if they come, they could well be more like the stop-start affair of the mid-1990s, rather than the inverted Vs of the last 25 years. With all that said, please remember, none of this is investment advice. These are just observations for educational purposes only, and everyone should be aware of their own investment objectives and risk profiles. But thanks for watching.